Welcome to the on-demand presentation of the RIMS webinar sponsored by Parametrix Insurance, Cyber Solutions, Parametric Protection of the Digital Supply Chain. I am Justin Smollison, Business Content Manager here at RIMS, the Risk and Insurance Management Society. A few notes before we begin. You may send your questions to pd@rims.org and we can forward your questions to the Parametrics team. All downloads and contact information will be accessible to the sponsor. Also, folks, RIMS is hosting Riskworld in Atlanta, Georgia from April 30th through May 3rd, 2023, and we are thrilled that Parametrics will be a presenter. Parametrics CTO, Netta Rosie, whom you'll meet shortly, will present a new way to model risk at the Innovation Hub at Riskworld at 12:30 p.m. on Monday, May 1st. We want to see you there, so register at rims.org/riskworld. And on with today's presentation. Businesses rely increasingly on the cloud for every minute of their productivity, but the cloud goes down often. Conventional cyber insurance does not cover cloud downtime adequately, if at all. However, parametric insurance products can do so very effectively. Today's panelists are here to delve deeper into the reliability of the cloud, explain how parametric coverage works, and how it addresses the challenges to the digital supply chain and the various remedies available. RIMS is thrilled to welcome you to this special on-demand presentation. I will kick off the session by first introducing Parametrics co-founder and Chief Technology Officer, Netta Rosie.
Hello, everyone. Thank you, Justin, for that introduction. My name is Netta. I'm a co-founder and the CTO at Parametrix. Parametrix has created essentially cloud downtime insurance, and we protect businesses from the risk of downtime when the cloud or cloud applications go down. I'd like to actually do a quick round of introductions before we get started. I think, Lori, do you want to go first?
Sure. Hi, I'm Lori Floresca. I'm a partner at Woodruff Sawyer, and my longtime background is actually directors and officers insurance. About 10 years ago, I expanded my practice to cyber, which was becoming such a challenging topic for my clients. I work primarily with technology and consumer-facing companies, advising them on risk in both of those areas.
Thank you. Chris?
Yeah, hi everyone. I'm Chris Moore. I run the Apollo Syndicate 1971 at Lloyd's. For those who don't know, Apollo 1971, we're a tech-focused digital syndicate. So we look at all things in digital tech platforms, whether that's the sharing economy, new mobility, or really anything that has a tech focus that's solving new and emerging risks. So really excited for this. Thank you for inviting me.
And Rick.
Hi, everyone. My name is Rick. I'm currently the head of insurance over here at Parametrics. I've been in the industry for about 20 years, holding roles at AIG and Hiscox. My historic focus has been D&O like Lori, but also dabbling in cyber and professional liability. Really looking forward to the discussion today and glad to be here.
Great. So thank you, everyone. We're going to go through a couple minutes of a quick presentation that will frame the topic of our conversation today, and then we will kick it off to general questions that we have on the webinar today. So the supply chain as we know it today is, or as we think of it today, is more around design, manufacturing, packaging, transportation. And when we think supply chain, we think trucks or we think planes. We don't necessarily immediately think technology, cloud, or third-party services. But in today's world, there is also the digital supply chain, which has been created over recent years and is evolving very, very quickly. And when we think digital supply chain, we think payment systems, cloud, internet providers, platforms, marketplaces, things of this sort that companies today build themselves on top of and that are all intertwined in this web of connections and dependency on top of one another. So you could have a company that relies on third-party services and it relies on these CRMs or these payment systems, But those CRMs and payment systems rely on their own third-party services. And then you get this complex web where it's really difficult to understand sometimes where a single point of failure may lie, or where you have a security risk, for example. And this is what we deem as the digital supply chain. Now, the risks that we can see are mainly categorized into two main risks. One is the system failure risk and everything that that belongs under that category, which is mainly third-party IT outages. And the second is security failure risks, which are all the cyber risks, cyber attacks.
Netta, can I just hop in for just 1 second?
Mm-hmm.
Could you, I just want to make sure, if I believe everyone should be able to see the screen. If you're not, I'm not exactly sure why you wouldn't, but don't worry, the video will be available through the on-demand webinar. So hang out and you'll at least be able to hear the discussion. Back to you.
For those that can't see the screen, we only have 2 or 3 slides left, and the rest is just a conversation between the panelists. So hang in there, and we're almost through the slides themselves. So when it comes to the digital supply chain, one of the biggest pieces of the supply chain is the cloud. And when we say cloud, we mean cloud service providers like Amazon's web services, Microsoft Azure, Google's cloud. Those are the top 3 service providers in cloud. Now, cloud is an industry that has grown to $590 billion in a very short period of time. So when you think of cloud, Amazon's web services were launched in 2006. And so for that duration of time to become a $590 billion industry is a very short duration of time. And this is due to the very quick adoption that businesses have when moving to digital solutions and using the digital supply chain. Now, this is becoming such a big risk that even that public companies today have this risk in their 10K. So they actually will state that this is a risk that they are aware of and are looking to prevent in multiple ways. Downtime, when it happens, it reaches the news. You see many articles, and it really is this big talked about point. And Parametrics actually conducted a survey where we saw that 82% of decision makers say that their business is dependent on the availability of the cloud. 40% of enterprises say that a single hour of downtime could cost them anywhere between $1 to $5 million. And 1,190 performance disruptions reported in 2022 were reported as critical disruption, which is the highest level of disruption that we see in the cloud. So what are we going to be talking about today? So today's discussion is about the digital supply chain in general. What is it and what does it look like? Cyber and availability exposures of the digital supply chain, dependence on the digital supply chain today. One of the biggest risks, which is cloud downtime. And if we have time for it, we'll dive into some parametric insurance questions as well. So Justin, I'm going to hand it back to you, and I will stop sharing as well, and we can kick off.
All right, everyone, let's get started. Can you hear me okay?
Yes.
All right. Chris, the first question is for you. In the digital age, how can the insurance market better serve clients?
Yeah, I think what the insurance industry as a whole needs to do is really move away from the standard sort of buyer-supplier model. We've been really good at that. We've been very good at saying, come on into our lovely insurance shop and pick one of our fancy products off the shelf. What the new digital companies of today and tomorrow want is they want a strategic partnership. They don't want us to focus purely on products. They want us to talk about solutions. Now, we have a huge amount of intellectual property. We have a huge amount of licenses and regulatory sort of expertise. We also have access to a huge amount of capital. So there's a lot of big good things that people come to insurers for, but they want a different experience. And what they want is that ability to, okay, these are the risks that we're facing as a business. These are the risks that we're overly concerned about. Can we collaborate and co-create to find a solution together? And in a lot of that digital space and new emerging risk, there's not huge amounts of data to sort of rely on how you create that. And that's one of the major frustrations I feel that digital companies have when they're trying to create new insurance products or new insurance solutions. And so how do you achieve that as an insurer? It's, for me, all about culture. You have to have a culture of innovation. You have to have that desire to put the client first and truly mean it, and put yourself in the client's shoes to say, right, okay, what is the part of the value chain of this business? What is part of the risk that I'm trying to protect? And how do I tailor my product so it does exactly that? So it's fit for purpose for those clients. Because really, if you don't do that, then really, what are you really competing on? You're going to be competing on price. You're going to be offering the same sort of product that everyone else does. And that's what doesn't foster a partnership. That's where you don't have these long-term relationships. So for me, it's you need to embrace your clients, understand your clients, spend a lot more time with them, and create something that's bespoke.
All right. What do you feel is the risk if the market does not engage in strategic partnerships?
It's a big one. It's a really big one. We've seen, if you look at, just simple examples of who the biggest companies are today and who the biggest companies are was as little as 5 or 10 years ago, it's completely different. And the top 5 companies are big tech, big digital, big data companies. And there are warning shots already that exist today. And my favorite one is Elon Musk, because he's very outspoken and doesn't mince his words, right? He's pretty upfront about what his thoughts and beliefs are, whether you like them or not. But, he has a great quote that I sort of keep as my warning or as my sort of call to action to make sure that we're trying to be as innovative as possible. And he is, if insurers continue to ignore the data and ignore the safety advances of our business model within Tesla, then we will insource insurance. And so he's widely spoken about the amount of actuaries that he's hiring, building his own insurance company. And these big tech companies, they have access to a lot of capital. So it's not a capital thing that they're coming to insurers for. But do they necessarily want to become an insurance company? I mean, I don't think so. It's a very highly regulated business. I'm sure the tech margins look very different to what us as insurers margins look like. But the reason that they are doing that is because they will refuse to allow insurers to be the blocker of innovation. They're not going to say, well, I want to do this and this is where I want to take my company, but I can't do it because of insurance. So they create their own insurance solution. And for us, I think that's really, we've got to look at ourselves and say, why are we forcing our companies to do this? If we can actually embrace that strategic partnership, we can create a product that is not only going to work for a company like Tesla, but it's going to work for lots of other companies. And this could be the product of the future that we're looking for. I know this is a cyber sort of based webinar, right? But if you ask most people in the insurance industry, what's the biggest opportunity? Most people say more cyber. I am excited about cyber and the opportunity. It's huge, but there are other verticals in the future that we should be looking at as well. And we'll only know what those verticals are if we open ourselves up to that culture of change and learning. So for me, in order to engage in that strategic partnership, you have to be better with your data, be more digital. So a lot of times you hear about insurance companies, it's like driving, looking in the rearview mirror, right? We're always talking about, give me that 10 years of developed loss experience. Well, that doesn't exist because the world is rapidly evolving in this digital environment. You can't do that anymore. So whilst these companies might not have that huge depth and length of data, the actual data they have now is so much more granular and so much more vast. We've just got to enhance our data capabilities and look at data in a different way. So if we can find ways to trust that data that Elon's talking about, and we can make that data an exchange and be very open with our assumptions and build a pricing model together, I think we can create something that's truly innovative. To do that, we have to get outside of the verticals that we've created, the verticals of this is marine and all I write is marine, and this is property and all I write is property, and this is casualty and all I write is casualty, because the new risks fall in the gaps of those verticals and we miss those opportunities. We have to get out of this 12-month cycle that we only speak to our clients when it comes up for renewal. That doesn't work. Our companies are rapidly evolving. You speak to them a lot more than that. And really, we just need to be more flexible and more agile. And I think where there is uncertainty, I think what you're seeing with a lot of big companies and the growth and rise in captives is people aren't afraid of taking risk, and you can co-insure with your clients. You can go on a journey with them. And that's the only way I think we're going to bridge this insurance gap is really changing the culture.
All right. And when you talk about those sorts of relationships and changing the culture, are there other examples that you want to mention, or other partnerships that you want to mention that you've been a part of?
Well, the obvious one is Parametrics, right? I think they're bridging a huge insurance gap. I'm not going to do it an injustice by talking about their product, right? They are the experts, and that's why we're thrilled to partner with them. But I love what they're doing, because this isn't, hey, let's be really innovative and add a little bell and whistle and add this little tiny feature onto an existing product so we can capture more market share. Okay, that's a great strategy, but it's not real innovation. What these guys are saying is this is a massive risk that people are really concerned about. There's not a product that exists today, so let's create a product and fill that need. That's brilliant. I think other examples that we're seeing of that would be in autonomy. I think autonomy and autonomous vehicles in particular is a great example of the insurance industry forcing a square peg into a round hole, right? If you talk to a lot of people about autonomous vehicles, which obviously I do because I love insurance, the argument becomes, is it auto liability? Is it product liability? Or is it cyber liability? Or is it public liability, general liability? It doesn't need to be any of those things. You can create something brand new. You can create an autonomous vehicle liability coverage. And that's the sort of the innovation that I like to see is new products for new risks. And it's completely tailored to those risks at hand, rather than, hey, let's add an endorsement to an existing policy and hope that covers the insurance gap that we have. So it's being brave, but I think being brave with the right partners that have data that they can constantly test the assumptions and be willing to be agile and flexible over time to tweak it. They're the sort of partnerships that really excite us at Apollo.
All right. Let's hear from Lori. Lori, how do you see the state of the cyber market, and do you see insurers and MGAs adapting in order to meet your clients' needs?
Well, I think to follow on what Chris is saying, I would argue that cyber insurance is an example of where insurers have really tried to innovate. But as we've seen this journey over the last 10 years, it's a really challenging task to create products that fit all companies and are able to respond to the new and changing landscape of threats that our clients are facing. So we do see a lot of additions and expansions to the product, which has made it kind of a convoluted mismatch of stuff at times, and people really have to understand what it is they're buying. If we go back, 10 plus years ago, really what we were all focused on was data breach. That was kind of all the innovation in this product was around how do we deal with these massive data breaches that we're seeing. How do we underwrite for that? And even the early options of the product that included business interruption coverage, which is, the outage piece that we're talking about here today, wasn't super popular. Either it was thrown in or companies didn't even really know they had it, or they would decline it with an option to reduce premium. People didn't care about it that much until we hit 2017, when we had the big NotPetya attacks that took out major companies, and we saw a real spotlight on this exposure. And so a lot more companies were showing interest in understanding that exposure and getting coverage. And at the same time, cyber was in a huge expansion phase as a market. There was, lots of insurers coming into it, trying to gain market share. And so we saw a pretty rapid development of expansion in coverage. So we went from just business interruption for your own network when you were attacked by a virus or malware or denial of service attack. Then we saw that expand to, well, what if it isn't malware? What if something just happens? What if you're just out? We started to call that an unexplained or unintentional outage. System failure became the term. So we had these two categories of coverage for your own network. If you were down because of an attack, or if you were down because of a human error, some sort of failure. And so that was a pretty robust expansion. Then, of course, we're all asking about the cloud. Well, what about, and 10 years ago, the cloud was not quite as big of a deal, but there were people that were relying on third parties. And so we started to get that coverage built in, that extension to that contingent business interruption. And so that expansion carried on for a few years. And we again there saw both the security failure aspect and the system failure aspect. But carriers started to ask a lot of questions, during this period as they're expanding coverage and really not changing premiums. In fact, premiums are going down because we were having market share, carriers trying to gather market share in a really competitive market with lots of participants. So there wasn't a lot of underwriting going into this. There wasn't a lot of premium supporting it. And I think we've seen in the last couple of years a lot more pullback in some of these areas as insurers start to wonder, do we really know what we're doing here? And do we have, the right product designed and the underwriting data behind it?
All right. So over the last 2 years, we've seen a drastic increase in premium and changes to cyber coverage. How do you feel that this has impacted cyber renewals and the coverage of digital supply chain risk? Big loaded question there.
Well, yeah, I mean, anybody that has been through a cyber renewal in the last 2 years has seen how rapidly the market has changed. And I think, it was a bit of timing of COVID and the dramatic increase in ransomware activity that really caught insurers by surprise. And, we really haven't seen as much on the big data breach side as we were seeing long ago. So that aspect of coverage has become less important part of the underwriting, I think, and the reason that companies are purchasing this. And now a lot of the focus has shifted to what is the scope of business interruption. And insurers are being much more cautious on how they're treating business interruption. They continue to be really worried about widespread events and the possibility of an outage taking out multiple clients at once. And that's where the cloud aspect of this gets very scary to them because, as Netta was saying earlier, there's a small number of cloud providers that virtually everyone is relying on now. We have such a concentration of risk. And so insurers are very nervous about how to underwrite to that. If they're asking an individual company questions about their security, that's one thing. They can get a comfort level with a particular customer, but how to get comfort with all of their vendors, and do their vendors all have good practices in place? How can they underwrite to that? And so we've seen, the last 2 years of the hard market we saw in cyber was a pullback on capacity, an increase in premiums, an increase in retentions and waiting periods. Now we're starting to see much more pullback in coverage in this third year of the challenging cyber market. And some of that is coming specifically aimed at system failure coverage, dependent business interruption, the cloud outage aspect. Carriers are very nervous on that. And because they have more leverage right now, because the market is more challenging, they're pulling back. They're putting co-insurance on some of those. They are reducing the limits they're offering for that contingent business interruption piece. So the market remains very challenging this year.
All right. Now, Lori, also, I just want to remind everyone, you're the one on the panel today wearing the lawyer hat, right?
I'm not a lawyer, no.
Oh, you're not?
No. I mean, obviously, I read a lot of contracts and dive deep into these issues, but not a lawyer by training, no.
Okay, so let's just call it the contract hat then. What would you recommend risk managers understand and watch out for to cope with the sorts of challenges that you just mentioned?
Well, I think it's, as Chris was saying earlier, it's really about taking advantage of the possibility of this product to tailor it to be custom to what your exposures are. Maybe there's pieces of this that you don't need to be buying as much limit in, and there's other pieces that you need more coverage. Really understanding what your legal obligations are. A lot of this is contract driven. We're seeing companies, basically everybody contractually demanding that everybody else buy some form of cyber insurance. And that exchange has really driven an explosion in this product. But are you really buying what's useful to your business and the scope of coverage that is particular to your risks? That's critical as a risk manager, to not be overbuying, but not be underbuying, and trying to find that sweet spot, because that's also going to drive changes in your cost. And then I think understanding what other new solutions out there, the parametrics piece is something that we're bringing to show our clients to plug gaps as we're seeing the cyber product evolve. The way it is covering cloud outage is not as robust or as simple as what Parametrics is offering. And in many cases, that might be a better fit for that risk for them than what they were getting from the cyber market, or it might complement that and you may layer the two products together. So there's a lot of ways to use this.
All right. Over to Netta. Netta, can you share with us a little bit on the dependency on availability of the digital supply chain in business today?
Yeah, definitely. So today, businesses will build themselves up on a lot of third-party solutions. Some of them are cloud, some of them are cloud applications. It can be anywhere from payment systems, CRMs, internet service providers, and cloud providers, marketplaces, all of the above. Now, understanding each one's availability is what is challenging in today's world. So being able to monitor how many days out of the month these services are up or down is becoming a challenge. It used to be that every company would have a server room in their company that was like this cold room, and probably a lot of them still have it. And you had a team that would go into this room and come out freezing, and just make sure that the servers were up and running. Today, that is slowly fading away. Well, I don't know if slowly, but it's fading away. And basically today what happens is companies will rent these services from third-party service providers and digital vendors. And that's what creates this supply chain. Now, instead of being in control of your own availability, now you're trusting these third-party service providers that their availability is enough for what your business needs. So some of them will have service level agreements where they will promise a certain level of availability. And if they breach that, then there's some sort of contractual liability to that. And I know that depending on how much availability your company needs, you may only work with vendors that promise a certain level of service level availability. And some will also monitor it themselves. So there's a lot of great monitoring tools out there that this is their sole responsibility, is to monitor your third-party vendors and to just let you know when there is a problem, so that, you know, your tech team can maybe try and there really isn't anything you can do to get that third-party service up and running, but maybe you have some sort of redundancy in place that you can trigger and get your product up and running again. So availability is definitely an issue. I think there's still more good features to these third-party services and the digital supply chain than bad features. So availability is just something that you have to keep in mind. But you know, all in all, it's a very very good change that I think is happening in our industries, and that's the reason we're seeing such a fast adoption.
All right. So I remember a while back, you know, RIMS, we had an article about speaking digital, how risk managers need to speak digital. And that reminded me that with your technology background and as a CTO, would you advise that risk managers learn how to quote unquote speak digital and when they're working with their tech team? Or do you have any other advice when it comes to collaborating with a tech team to address the risks related to the digital supply chain?
Yeah, I think they feel comfortable speaking digital, that is great. But even if they don't, I think just having a great partnership with your CISO, with your IT team, with your tech and engineering teams, understanding the risks that they may see and it may be clear to them, but you know, having that relationship with them so that they're openly addressing and letting you know at least what the risks are. They may try and mitigate them, but as long as you as a risk manager know that this risk exists, you can find a maybe financial or insurance solution for it versus a technological solution. So I definitely think it's important. I think it's important to map out where your single point of failures in a technology digital supply chain may be, and just be aware of them. I think this is where I would actually turn to your broker in this case. And once you're aware of this, of your single point of failures, or where you may have outages, downtime, security issues, cyber, holes in your coverage, this is where you'd have to work with your broker. And taking this back to what Lori had mentioned, is that I think it's really important to match the coverage to your company's needs. So not taking just this, umbrella coverage that covers everything and everything, or maybe not everything, but taking the standard kind of coverage and working with your broker, knowing what your risks are, and then working with your broker together to find a solution that will A, maybe fit the budget better, and B, will cover you more for either the same price or a lower price. So that's really, I think, where the risk managers can focus, but definitely speaking tech, and more of just having that relationship with your tech teams, I think, is really important.
All right. I've got a question for my friend Rick over there, who's been patiently waiting. Rick, I've got a great question for you. For the handful of audience members who may be unfamiliar with parametric insurance, could you explain for them what it is and how it works?
Yeah, no problem, Justin. Parametric insurance is known for its simplicity and transparency. It replaces the normal claims and litigation process by doing two things. One, it predefines coverage amounts for a specific type of loss. And then two, it defines the actual triggers for that loss. Right. And then when an event happens and it triggers a payment, right? It started off, and an easy example is flood. When you hit specific levels of water, it triggers different coverage payments. And in the case of our coverage, right, certain cloud providers experience downtime in specific regions, and that will trigger payment on our end. So it's pretty easy and meant to simplify the entire claims process.
That was a great answer. All right. Lori, back to you. In terms of traditional business insurance claims, we've seen quite a bit that are complicated and long relative to claims of the parametric model, taking even a few years to settle. I would not want to imagine 3 years of settling that. So could you share some of your experience and what you think is complicating these processes?
Yeah, I mean, that's absolutely right, that proving these losses are very tricky. And, the reality is that the insurers don't have a lot of experience in this space either. These are new areas of coverage. There hadn't been a lot of these claims, and especially we actually worked with a big company who had an extended outage and ended up being one of the first and largest business interruption claims that the cyber insurance market handled. And it took several years to get to a meaningful resolution. And there are still pieces of it that are actually in litigation with some excess insurers in terms of interpreting what the scope of costs that could be put into that related to the outage and become part of the claim. There's a lot of back and forth and forensic accounting required to really demonstrate what your losses, what your revenues would have been, what your costs would have been otherwise if the outage hadn't happened. Proving attribution, especially as we start to worry about, is it on our own network, or was it the cloud vendor's network that really caused the problem? Where did the intrusion happen? Where was the outage? All of these things are going to make these claims more and more complicated as we go forward. We may have sublimits in some cases, depending on whether it was the third party's network or your own network. Co-insurance provisions that are complicated to apply. And, especially given the hard market we've just been through, we're talking about towers that have lots and lots of insurers because people cut their limits. And, in order to get to 20 million or 50 million, you might be working in blocks of 5 million or sometimes even less. And so you have lots and lots of insurers who are each looking at that primary policy and interpreting that language differently. So these are very complicated claims, and certainly have taken years in the past to settle. And I think even new ones now have that same challenge going forward, that these are always going to be very complicated losses.
All right. Back to my friend Chris. Chris, you there?
Yep.
All righty. While working mainly with digital clients and platforms in the last few years, do you see a change in their expectations of how claims should be handled?
Yes, in a major way. But I also think that in order to answer this question, there's been other shifts that have created a different sort of approach to claims and a different expectation. What you're seeing with digital platforms is a frustration with insurance and them looking at the value chain for their customers to say, what can I improve, right? So people want to be brand loving and they look at all the things that they can help for their user base. And one of those is insurance. Everyone on this panel, I'm sure, whilst they might love working in insurance, will not be a fan of buying their own personal insurance. It is a horrible process. No one reads their own policy. I've never read my home insurance policy or my motor insurance policy, and it's just a terrible user experience. And so what you're seeing is these major platforms, digital platforms, saying, well, I'm kind of changing behaviors, right? And I'm interacting with so many users, and there's an opportunity for me to improve their user experience and within insurance. And so you hear this buzzword of embedded insurance. Don't think of embedded insurance as just retail, right? I buy a product and I can click here and buy insurance. Embedded insurance can be across a massive, massive scale into all sorts of products, right? And I'm sure Parametrics can offer lots of embedded insurance to lots of tech providers where, those coverages are built into the overall product and service. What that creates is a huge shift from personal lines into a commercial line setting. And when you're in that commercial line setting, where it's the digital platform that's saying, okay, I'm a mobility platform, so anytime you lease one of my vehicles, anytime you get in one of my vehicles or whatever it is, there's embedded insurance. You don't need to worry about insurance as the driver. All of a sudden, those claims that would have ordinarily sat on those individuals are now sat within their domain, and they are promising that amazing user experience. And so claims is a huge part of that user experience, right? That is the product of insurance. And it's always been, part of our product that has been lousy. And so these digital platforms are making us modernize and saying, look, my whole platform is built on trust, and people trust my product and service. So when it goes wrong, I have to have that trust in the claims. That claims process has to be as good as the product and service that we have. If you were to name the brands you love, I'd be surprised if anyone reels off their big insurance carriers, right? People love the Airbnbs, the Ubers, the British Airways, all these brands, Nike, whoever it is, you don't often see an insurer in there. And so what these platforms are saying is, if I embed insurance within it, I want my claims process, my insurance process to be as good as the rest of my business. So what do you need? You need speed, you need clarity, you need to be very proactive, and you need to really embrace the data. And I think the data piece here is also super important. I was working with a very large tech platform and quite openly said, insurers are just data vampires. You just ingest all this data, you keep asking us for it, you don't even know what you're going to do with it, and I don't see anything in return for it. Now, whilst that was a real offense, so I took it and crushed my world, there's a lot of truth in what they're saying. It is a one-way process. It's very rare for insurers to share back with their insureds or even their brokers to say, hey, this is how the risk is performing. This is the sort of data we're seeing. These are the sort of things that we can do differently. These are the sort of things that you can manage to improve your insurance experience, improve your insurance spend. We're fascinated by risk transfer and we underestimate the risk control, the risk avoidance and all that sort of stuff. So we need to get better at that data exchange. We need to be able to say, look, this is what your data looks like. This is where your claims are coming from. This is where your area of focus needs to be. And we can tell people on a really dynamic base where they're performing better than expected. And that will take out this cyclical type or uncertainty about what rate change is going to be when I renew my policy in 12 months. So one, it needs to be two ways. What digital platforms have been really good at is, collecting huge amounts of data on their exposure. The problem we have on the claim side is the claim side is normally handled by insurers who aren't as tech and digital savvy. And so I've seen platforms that could tell me, so if we take a mobility platform again, or like a delivery platform, they can tell me what their delivery drivers, what time they started, how they drive, when they drive, where they drive, how often they take a break, the most granular data set you could ever want. And then when I go to, and how does that work with the claims? They'll go, Well, because our claims data set is basically with a TPA or an insurer, there's no way to bridge my exposure data set with my claims data set. So I can't even bridge and see where the claims are coming from. So it's almost there's nothing I could do with the data from a claims perspective. That's where we need to modernize. And that's what digital platforms are taking on themselves to say, if I can really tie that huge granular exposure data set with a claims data set, it empowers me as a platform to make better risk-based decisions. And that's what's super, super exciting, right? To say I can almost create a trust score, an individual risk score, rather than just have this bucket of aggregated risk and trying to spot overarching trends. The more granular you get on that claims data, the more clean that claims data and that whole process is, the more empowering it is to really control an insurance program. So that's where I think the digital clients are saying it's not enough for you to have you have a claims team and they handle claims. It's how tech savvy, how data savvy is your claims. Can I get instant notification? And when I get that notification, I want to know every single part of the exposure basis so I can handle that claim as quickly and as efficiently possible to protect that trust that I was talking about. And parametric triggers, like what Rick said, have a massive improvement in that claims process, because you're removing massive layers of unnecessary complexity. You're allowing for a much smoother process. People know exactly how their coverage works. People know exactly when their payment should work. And again, you're reinforcing that trust. So I think it's all about, we know what the claims function should do, but we need to modernize it, digitalize it, make it a lot better, because these digital platforms will not accept a poor user experience. You won't be an insurance partner for them for long unless the claims is right. I don't care how good your underwriting, your actuarial, your sales, your marketing, your brand, it's claims where you will lose your business.
All right. And
I sorry, I want to just say that it really is claims. And I think that's where Parametrics actually started off, was we were looking at the claims process and we wanted to improve it. And then we came across the parametric model that eliminated it. And we were like, well, that just makes our life so much easier. But really the problem that Parametric set out to solve initially was the claims problem, and making that a good user experience rather than just a process you have to go through. So sorry to cut you off there, Justin. I just wanted to echo what Chris is saying.
no, that's great. That's great. Let's keep the dialogue going. Rick, I had a question for you, and that was about downtime events. What are the types of losses that you typically see from a downtime event caused by the failure of a TPA or a third-party service?
So the losses can be pretty broad. They can be anything from pure revenue loss, right? There's the opportunity cost loss, customer churn, reputation loss. Anything that kind of impacts the company in a negative way would constitute a loss. And when you think about it, that can be almost anything, right? And so when you look at cloud exposures and what you're looking at as a potential insured, you need to make sure that that definition of loss is broad enough to cover all of those things, and you can get the benefit from the policy that is inclusive of SLA coverages, right? And the customer acquisition costs that you would need to incur to get clients back if you had lost them during that downtime event. So it is a pretty broad definition, and so you need to make sure that whatever policy you have in place does cover all those exposures.
All right. Netta, since you're the resident CTO here, what do you feel causes cloud downtime events, or what are the most frequent ones that you see?
So the causes for downtime, and it's actually not necessarily just cloud. I think when we're talking about digital supply chain, it can be any one of those pieces of the web. It can be a couple of things. One is a power outage. It could be some problem with the physical infrastructure of either the servers or where the technology lies. It can be connectivity and internet. That one's a really big one. We have many ISPs, internet service providers, and they are traversing large amounts of data across the globe. And so they definitely have connectivity issues every now and again. System overload. So, you can think like Black Friday, everyone going into a website, and the website just being more overloaded than what it was initially produced to be able to withstand. And it can be, cyber attacks, where cyber attack can be set in two types. It can either be bringing down your system, or it can be going into your system and kind of staying silent around the system for a while until an opportunity comes up, either to steal data or to bring your system down at a more convenient time. And actually, one of the biggest, and it's the main reason that we see for downtime, which was quite surprising to me initially, is that human error is actually the biggest reason for an outage. And it's not any of the other, physical infrastructure, internet, connectivity, none of that. It's really just a developer somewhere within, Google or Amazon that has made a mistake, or there's a bug that was undiscovered by the testing, some configuration change that didn't roll out like they were expecting it to. That's actually the biggest reason for outages across the digital supply chain. And that's something that, as long as we're humans, that's really not going away. And we see that quite often.
Reminds me of that old song, I'm only human, born to make mistakes. All right. Netta, since you kind of piqued my interest there, I want you to take us through a typical cloud downtime event.
So is this just an example of an outage event, or kind of what it looks like on, like, if you can rephrase that question?
Yeah, sure. I mean, could you take us through one?
Through just
maybe
a
something that you
downtime event,
monitored?
like an example of
Yeah.
what an event would look like.
Sure.
Yeah, so let's say that there's a human error, because that's the most common cause for outage. What would happen is there, let's say, is a bug that's in the system now, and it's causing the system to not be able to produce as much traffic as was initially expected. And so I can even give an example of this. There was a Microsoft Azure outage in one of their data centers. Actually, I think it would probably be about a year ago, that caused this data center to be out for over 14 hours, just due to a human error. And there were a lot of different services that were affected, both the computational service and also the auto scaling service that relies on the computational service. So sometimes we even see this dependency within the cloud. And then what that would look like is all of the customers that are reliant on the cloud all of a sudden can't access their computational power, meaning their production systems, and they experience an outage. So their product is unavailable. And then usually what happens, especially when it comes to human error, root cause outage, is that once the cloud provider sees that there's this bug, they'll try and roll it back as quickly as possible. And usually that happens. Usually that's relatively quick, but in the case of the example I gave, it took them 14 hours because this outage also affected other services in the chain. So they had to roll it back on a few different services. And so it really was this big impact. And so I didn't really mention this, but Parametrics has developed technology that monitors for outages. And so when an outage happens, our monitoring system looks at that outage and really can produce metrics about that, the severity of the outage, the duration of the outage, who was impacted, when, where, and how. And so we see outages like this all the time. I'd say pretty much every day, with different severity levels. So the example that I gave, the 14-hour outage, was a severe outage. There's different levels of outages, but they really happen all the time, and we're tracking them across all of the major service providers.
Now, that monitoring system is called the Parametrics Cloud Monitoring System, or PCMS, in case anybody wants to shorten it, right?
Yes, exactly.
All right. And anything else you want to add about the PCMS before we move on?
I just say that it's our own proprietary technology that we developed, and actually taking this back to what Chris was talking about, where innovation comes from. We chose to bring our innovation from technology. So this is where our strong suit, the founder's strong suit, lies. We came from technology companies, some of them even monitoring technology companies. And so this was what we chose to bring in and innovate. Apart from just the way that our insurance product is structured, we also have this very intricate piece of technology that is underlying it and generating massive amounts of data. We have almost 80 million data points that are generated a day. And based off of those data points, that's how we detect these outages across multiple metrics that we create from that data. So it's quite a robust system that we've created. We monitor over 270 data centers, or regions as they're called in cloud terminology. And this is, something that we bring to the table for the insurance industry.
Excellent. So we've got a couple of questions from the audience that we really want to get to because they're really great questions. I want to take the earlier one first because I'm sure that the person who's out there in the world who asked it has been waiting very patiently for us. So I'm going to find that right now. And the question is, how do clients and insurers measure and model cloud risk? Or how should they do it? Who wants to go first?
Maybe I'll kick off from the client's perspective and what we see. I mean, I do think this has been a really challenging area for companies to understand their own risk. If you, again, back to kind of my story about the evolution of cyber insurance, when we were talking about data breach, it was, calculations. How many records do you have? What's the cost per record to notify someone? We could do some quick calculations and help companies understand their exposure. When you're talking about outages, it's a little different because it depends on what system goes down, and it depends on how revenue dependent you are on uptime, and that can vary by product or by internal system versus cloud providers. And so really understanding which of your systems you are most dependent on, what are the revenue implications of that, where are you likely to incur extra costs. Sometimes it's just going to be things get pushed out a while, and you're going to have a lot of backlog of dealing with back end stuff, but your customers are still going to be operating fine. In other cases, you may have no visibility to your customers, and those customers are going to go away and buy somewhere else. And so understanding what the different possible scenarios are is really challenging for companies in this space. And then mapping that to a solution. Do you have a cyber insurance product that is covering all of those vendors, or are they requiring you to name specific ones? Are they covering them for all types of outage perils or only for malware? Are you going to be able to find that out? Attribution can be a really tricky thing from your cloud vendors. They may not be willing to tell you everything about their outage, and that may cause complications in how your cyber insurance policy would respond differently than how a Parametrics policy would respond, where the outage is just, if it happens, it happens, and you get paid. So understanding what those scenarios are and how they apply to your business is really important here.
Yeah, and just to touch on that, I think that last point is so relevant, right? When we look at a standard or a traditional liability policy, and I'm sure Laurie has great experience with this, there's huge amounts of underinsurance. And the reason there's a lot of underinsurance is it's a really complex purchase. You do a huge amount of underwriting process. And when you build these towers of liability, it's not uncommon to have, and especially in the harder market that Laurie touched on earlier as well, with these retention of limits, you can have 10 different carriers with 10 different policy forms with 10 different coverages. And that's why these disputes go on, because everyone's got a different interpretation of how the policy responds to this specific loss. And you can understand the frustrations from a client to say, hey, I've never had a claim. I bought insurance coverage for that catastrophe event that, you know, couldn't be controlled. It's now happened, and I'm 3 years waiting for my claim to be paid. Huge impact on my business, huge cash flow sort of issues. And I still don't know if I'm not going to be paid because everyone's disputing the coverage. So when you put a parametric solution in place, you remove a lot of that complexity. Because it's a standardized product this is how it responds. It's very simple. You don't have that difference. You can build a real large tower of capacity that all responds in the exact same way. You can see the attraction from a client to say, that's the sort of product I want to buy because I understand it. I know when it's going to respond. I know when it's not going to respond. And so with a parametric solution, you can build more capacity. You should have less uncertainty, which means from a pricing perspective, insurers do not load up for the uncertainty. So it's a more accurate reflection of the pricing. So when we talk about claims being so important, the trust, the speed, the user experience, Parametric is catering for that by bringing more capacity, that simple view. It should be paid quicker. There's a huge amount of benefit upside if this is done correctly and done well.
All right. And we've got one more really great question from the audience, and I do want to make sure that we get to it. There seems to be a massive catastrophic potential for one of these big providers. Is the parametric market large enough to respond, or will there be exclusions to mass events? I saw Lori smiling there. So whoever wants to go first.
Well, I was going to say,
put you on the spot.
I think it's a great question for Parametrics relative to their product. It is something that the broader cyber insurance market is very worried about. And we have seen just in the last year in particular, major insurers coming out with a new treatment for widespread events. So far, not necessarily restricting coverage, but sort of setting up to do so, setting up the policies so that they can differentiate between kind of individual risk and widespread risk. And what we may see what we're starting to see is insurers applying different terms to that widespread risk. Maybe it's co-insurance, maybe it's sublimiting it, but there is a real concern about that widespread event taking out the cyber insurance market. And so the traditional market has been really watching that.
All right, so Netta is going to share her screen momentarily with a super cool QR code. If you've ever wondered how often the cloud fails and how much downtime would cost your business, Parametric's 2022 Cloud Outage Risk Report provides insights into the persistence and impact of cloud outages based on the observations recorded by the PCMS, the Parametrics Cloud Monitoring System. You can download a copy at the link in the QR code on your screen. This was such a great session. I want to thank everyone. RIMS would like to thank Lori Floresca of Woodruff Sawyer, Chris Moore of Apollo, and of course, Rick Wong and Netta Rosie of Parametrics for their time and expertise. A copy of this webinar will be available on the on-demand events page of rims.org within a few business days. For more information, visit parametricsinsurance.com. Folks, also remember, public registration is open for Riskworld 2023, which will be held in Atlanta, Georgia, April 30th through May 3rd. We are delighted to have Parametrics there as well. You can find Netta along with the Parametrics team, who will be presenting a new way to model risk at the Innovation Hub at 12:30 p.m. on Monday, May 1st. That's right before lunch. So get your knowledge and then go eat. Continue to broaden your risk knowledge with Parametrics and RIMS at Riskworld. Register at rims.org/Riskworld. Tell Netta that you saw her on this webinar, and we want to see you there. RIMS is global, and we'd love for you to build your network with us. Visit rims.org/membership to apply for a RIMS membership. Thank you all, and stay safe.
Thank you. Both the Woodruff and Apollo teams are going to be there too.
Oh,
So definitely look for them during RIMS.
It'll be a fun reunion then. All right, everyone. Take care.
Guys.
Thanks.